Good afternoon, this is Mark Espy with MarketTamer.com. I am also known as the Robinhood Trader. We find ourselves on Friday afternoon, the 2nd of July, just before a 3-day holiday weekend, Independence Day. And the market is closed on Monday. Before we begin, I must remind everyone that everything we speak about here is for educational purposes only, never to be construed as a recommendation to buy or sell anything. Please do your own due diligence. Well, we had a terribly bearish week. You can see here that we began with a doji that followed up the high wave doji that appeared last Friday. Then we had a huge down day on Tuesday, a follow-through day on Wednesday, and then a quasi-type of, not a classic, but a quasi-type hammer pattern yesterday, Thursday, and today we had an indecisive day with a spinning top. Together, in combination, these two candlesticks the last 2 days have formed what I call a tweezer bottom. You'll notice that the wicks for both of the days have moved down almost equidistant, and that's why they call it a tweezer bottom, rejecting lower price levels, which would bode for a bullish move to the upside. The significant thing here is that we broke below this line here. This is the neckline of a head and shoulders, and it's drawn between this swing low and this swing low, which is a trough between the shoulder, the head, and the shoulder over here. Left shoulder, head, and right shoulder. And that is significantly bearish if we get follow through. It did close below that line, but it seems to want to reject lower price level. Now, if it continues below here, the first level I'm going to look at is a swing low from November 2009. At 96.79, and then there's also a swing high from November 2008 at 96.54. If it breaks below both of those areas, I'll be looking below 9,500. The 9,500 area is actually pretty stout support. More specifically, 94.28. There's some good market symmetry that extends back several years with a swing high and swing low. There are several of them that made touches at that level, as well as a Fibonacci level. The stochastic is residing here in the oversold area, and it looks like the %K line wants to cross over the %D line, and if it does that, it may begin to escalate out of here, which would be a bullish sign. The MACD doesn't appear to be telling me the same story, and in fact the histogram is moving further away from the zero line, which indicates continuing momentum to the downside. If we break to the top, if we go up, we would be looking at this level here, the swing high at 10,600, this swing high at 10,900, and obviously the April 26th high. So those are the areas we'd look for there. This is something I've really been keeping my eye on. This is the 50 simple moving average. This blue line is about ready to cross over the red line, which is the 200 simple moving average. If that happens, that will be significant. That's no small occurrence. We need to pay attention to that. I also noticed today, it's quite interesting that the VIX closed down today, and you would think with continuing movement to the downside that would not have occurred, and in fact it closed down 2.74 points to 30.12. So that's quite curious to see that, especially with a continuing bearish movement. The VIX is a fear indicator at the CBOE and an indication of people chasing after puts to protect positions and bearish sentiment, yet it didn't escalate. So maybe that, in combination with this tweezer bottom right at this level, might bode for a move back up, but we shall see. Okay, with that, we're going to move over and take a look at the SPX.